is Chad Staskell with Eagle Wealth Management. Welcome to our 2018 Annual State of the Markets presentation. I'm happy you're joining us and look forward to sharing some important information with you. I'd like to draw your attention to these disclosures. I want to keep the regulators and attorneys happy. First and foremost, past performance is not a guarantee of future results. Also, since this is recorded, the statements and forecasts are based on the information we have at the time we prepare this presentation and are subject to change without notice. The financial world is incredibly complex, and these days, we're all bombarded with dramatic headlines and contrasting opinions. So, our goal today is to educate you about some of the factors we, and the expert financial analysts, are watching. Of course, it would be impossible for us to cover everything, but we will try to touch on the most relevant factors. And while past performance does not guarantee future results, we will focus on the trends that may help guide the decision-making process when investing. Here's what we're going to talk about today. What happened in 2017? What other factors affected the markets? What's on the horizon? And what do financial experts forecast for 2018? Let's start off by talking about how to put last year's stock performance into perspective. In 2017, markets soared to new highs on solid economic expansion. The S&P 500, Dow, and NASDAQ all repeatedly broke new records. And, with record low volatility, the bull market just kept charging. President Trump's inauguration in January further encouraged the already growing markets. The solid market performances also helped push the Federal Reserve to raise interest rates 3 times throughout 2017. During the summer, some investors expressed concern over key events: Hurricanes Harvey and Irma, rising tensions between the U.S. and North Korea. But a focus on market fundamentals became crucial. Keeping this perspective helped investors to capitalize on the economy's upward momentum. In December, the House and Senate reached an agreement on a tax reform bill that supporters claim will help businesses boost the gross domestic product. On December 22nd, that bill was passed into law. Finally, despite posting losses in the year's last trading week, all major indexes still ended 2017 far higher than they began. At the end of 2016, well-known analysts gave their predictions for the S&P 500 performance in 2017. They all predicted that the index would grow, but even the most optimistic target was still more than 200 points below the actual results. Ultimately, the S&P 500 went far and beyond expectations to close the year at a 19.4% gain. And the S&P 500 wasn't the only domestic index that performed well. The Dow increased by 25% and the NASDAQ was up over 28%. So, we've seen that 2017 brought a significant growth to the markets, but let's dig deeper into some of the factors that contributed to performance last year. We're going to cover the labor market, housing, consumer spending, corporate growth, and also inflation. 2017 was a solid year for American workers. The unemployment rate dropped to 4.1%, the lowest rate since before the dot-com bubble. And in December, we hit the 87th consecutive month of job growth. While the labor market experienced some volatility due to Hurricanes Harvey and Irma, the unemployment rate remained at a 17-year low. With that said, wage growth has been relatively sluggish, hovering at 2.5% increase for the year. Understanding the scope of growth in the labor market and where the jobs are coming from can be very eye-opening. The total private payroll chart reveals that the economy lost 8.8 million jobs during the Great Recession. During the recovery, we gained back twice as many, with 17.1 million new jobs created between 2010 and 2017. And where did those jobs come from? Industries related to information, financial services, and professional and business services gained 5.1 million jobs. On the other end of the spectrum, we lost 100,000 government jobs compared to February of 2010. 2017 gave us a lot of perspective insight into home sales. The last data available in 2017 comes from November, and it indicates the industry is performing very well. In November, both new and existing home sales were at the highest they'd been in at least a decade. Year over year, existing home sales were up 3.8%, while prices increased by 5.8%. In that same period, new home sales jumped a massive 26.6%, even though prices were a little bit more modest increase of 1.2%. Even with this huge jump in new home sales, they still represent a lower percentage of home sales than the decade before the housing bubble burst. In other words, new home sales may still have some room to grow. In fact, some analysts believe new home sales still have a good bit of growth potential, which would also benefit the home building industry. Overall, as the economy picks up speed, the housing industry is going to foster growth. Consumer spending accounts for more than 2/3 of gross domestic product. So the health of individual financial lives is an important facet to understand when analyzing economic strength. Judging from the recent data, consumers are starting to feel the effects of economic growth and the increase in their spending in response. As of reports from December 2017, consumer spending had increased 4.5% year over year. Incomes had also gained 3.8% from the same time in 2016. This chart gives a month-by-month breakdown of how much consumer spending and personal income have increased in recent months. With the exception of personal income staying flat in June 2017, both measures had been on a rise for over a year. But November's data does give us one potential challenge to be aware of. Spending is increasing faster than incomes. As we all know, spending more than you make can be a recipe for debt. Currently, debt-to-income ratios are near the lowest rates in the last 35 years. But this is one detail that we will continue to pay attention to as 2018 progresses. In 2017, businesses continued the growth we've seen over the past several quarters. During the third quarter earnings season, which in the last quarter we have data for, 72.8% of companies in the S&P 500 beat their expected earnings, and 68.1% beat their revenue expectations as well. Overall, analysts anticipate these earnings will be 8.4% higher than the same time last year. And while data for the final quarter of 2017 isn't available yet, the estimated earnings growth are even higher at between 10.6 and 11.6%. If we look at this chart, you can see that corporate earnings have grown since the third quarter of 2016. Analysts at Thomson Reuters expects them to keep rising at least through the second quarter of 2019. Let's talk about inflationary trends for a moment. Inflation is a general rise in the price of goods and services and is one of the key indicators of economic well-being. Though the relationship between inflation and the stock market is complex, generally speaking, stable, modest inflation is better for equities than high or volatile inflation. If you take a look at the box in the middle of this chart, you'll see several acronyms. CPI, it stands for Consumer Price Index, and the headline CPI is the most popular measure of inflation. The federal government puts out this data and tracks price trends in a large number of goods bought and sold in the United States. The core CPI below it strips out volatile food and fuel prices to focus on long-term inflation trends. You can see that the brown CPI line jumps around much more than the yellow core CPI line. That's because food and energy prices tend to be very volatile in the short run. Though the past doesn't always reflect the future, historically, a sudden run-up in prices has often preceded or accompanied a recession. Note the huge inflationary spikes during the 1970s oil crisis and the 1980s recession. At 2.2%, the headline CPI as of November 2017 is well below the 50-year average. In addition, the core PCE deflator, which the Federal Reserve uses as its primary inflation measure, was less than half its 50-year average. At 1.5%, the core PCE deflator is also below the Fed's 2% benchmark. The Fed has a mandate to foster to foster maximum employment and price stability. They believe a 2% rate can support accurate financial forecasting and decisions while preventing harmful deflation. We're confident that the U.S. economy is on the right track. Yet, we know the stock market doesn't always follow the economy. One major indicator of economic health is consumer sentiment. Essentially, this is a survey that asks regular Americans how they feel about the economy and their financial prospects. It's an important indicator because sentiment has a strong relationship with consumer spending, and consumer spending drives 2/3 of economic growth. Sentiment can also connect to market performance, but in more complicated ways than you may expect. Consumer sentiment is typically a rational reaction to a strong economy. However, it can also signal irrational investor exuberance when prices climb to unsustainable levels. Historically, recessions sometimes follow periods of high consumer sentiment. We see those recessionary periods on the chart as vertical shaded areas. Is it always the case? No. We can see that it wasn't the case in 1977, 1984, or 2004. But it did happen in 1972, 2000, and 2007. In October 2017, consumer sentiment hit 100.07, the highest reading we've seen since 2004. Though consumer sentiment fell to 98.5 in November and 96.8 in December, it itself remains in positive territory. Household finances helped raise consumer attitudes on the back of a strong economy, low unemployment rates, and, of course, market highs. Later in this presentation, we're going to offer some reasons for this high consumer sentiment reading and why we should stay optimistic about the markets. But we will still keep an eye on this measurement because it can indicate the market could trend downwards. I like the way that Warren Buffett phrases it. Be fearful when others are greedy, and greedy when others are fearful. What does that mean for us? Don't get caught up in what others are thinking or doing. Be cautious, watchful, and prudent about managing risk, even when the crowd is going the other way. Before looking forward, let's reflect on the past. Last year, we imagined potential headlines that could happen in the future and gave both optimistic and pessimistic scenarios. From a positive view, we imagined the stock market would perform well, businesses would invest in the U.S., and President Trump's economic policies would help accelerate the economy. We're happy to say these positive predictions came to be true in 2017. The market continues to hit new record highs, and new economic and tax policies have helped drive business. Thankfully, the potential risks we identified in 2017 never manifested. The European Union is still intact, we've avoided potential trade wars, and inflation remains low. But following market fundamentals and avoiding knee-jerk emotional decisions by following market fundamentals and avoiding knee-jerk emotional decisions, we maintained an optimistic outlook throughout last year. So, we've looked at some of the factors affecting market performance in 2017. Now let's examine the headwinds and tailwinds that could affect the speed and trajectory of economic growth in the near future. "2018 brings new questions about what the future may hold. If tensions with North Korea ease and the European Union continue to strengthen, new international opportunities may become available. And since a tax reform bill became law, Republicans are promising economic expansion. In this case, we imagine future headlines touting major accomplishments a few years from now. On the other hand, we could have a different picture 5 years from now. If some of the political risks and headwinds catch hold in our economy, the outlook becomes more concerning. If Trump is indicted, if we go to war with North Korea, if the European Union does struggle, ultimately no one can predict the future. And 2018 brings a noteworthy amount of political uncertainty. We believe times like these are when you have to focus on fundamentals and avoid focusing on emotions. We must look at what's really happening in our economy and what the data is showing us. Whether real or imagined, headlines are only helpful if we take time to think critically and look at them amid the hype. So, if recessions often trigger bear markets, do we have to worry about a recession this year? Let's look at a group of indicators that help ground our predictions and data. This slide takes us back to late 2008. Here we see a group of 20 indicators. These indicators help forecast pressure on the economy and financial markets in the next 3 to 6 months. Green is a positive for the economy. We could call that a tailwind pushing economic growth along. Yellow is a caution, and red is a headwind that acts as a brake on economic growth. Let's look at where we were in December 2008. Here we see lots of red on the board. The economy is in serious trouble. The housing market is deep in the red, volatility is high, the global economic outlook is negative, and business spending is dropping. Now let's look at where we were in January 2017. You see a lot more green on the board. The U.S. economic outlook is good. Consumer confidence is high. Corporate profits are growing, and we see many more positive signs. Overall, 16 of the 20 leading financial indicators report positive or strengthening numbers. There's no red on the screen. Here's where we are in December 2017. The only negative on the board comes from geopolitical risk. No surprise there. Our testy relationship with North Korea and the Russian collusion investigation have helped keep that particular speedometer in the red. But just as in January 2017, 17 of the 20 speedometers on the screen are green. These reflect our economy's strength and give us a positive outlook. Throughout the year, corporate profits rose. The global economic outlook improved, and the U.S. economic outlook remained strong. The yellow gauges are areas where analysts have some concerns, and we will continue to watch for developments, especially over the next 3 to 6 months. Though there's still room for improvement in 2018, our economy reflects strength and potential, especially when compared to 2008. Now, the past can't predict the future, and financial markets don't always act in concert with the economy. However, barring some unexpected economic shocks, we're confident the economic growth will continue for 2018. The markets have rallied since the presidential election, reaching one record high after another. But are investors too euphoric? Are equities overvalued? Let's examine this chart and see where their stocks are at a fair value. First of all, P/E ratio. It means the difference between a company's price per share, or P, and its earnings per share, or E. The higher the P/E ratio, the greater the difference between what the investor pays for a stock and what the company actually earns. So a high P/E ratio means stocks are relatively expensive compared to what their earnings are per share. If you look at the middle dotted line in this chart, you'll see the average P/E ratio is 16 times. In other words, over the past 25 years, stocks have averaged a per price share of 16 times their earnings per share. In the Great Recession, the P/E ratio is far below this average line, where it was high above the average during the dot-com boom. By December of 2017, P/E was at 18.2, which is above the 25-year average, but still within one standard deviation above average. The data tells us that we do not appear to be in a bubble, and instead, stocks are currently or fairly priced for their earnings, even though slightly above. So we've established that the P/E ratio is higher than the historical average, but still within one standard deviation of the number. If we look more closely at context, we can see that the current P/E is pretty normal for times when inflation is at as low as it is right now. In fact, since 1871, any time inflation has been between 1 and 2%, the S&P 500's P/E has been just over 20. At our current low inflation levels, then the 18.2 P/E is actually not too high at all and below the historical average when low inflation is here. Now that we've discussed 2017 performance, and what economic factors may come into play in the year ahead, let's get down to the details that I'm sure you're all interested to hear about. Predictions for the markets and economy in 2018. As we discussed earlier in the presentation, inflation is below its 50-year average. But what will happen in 2018? Let's take a look at the numbers here. This data shows the Consumer Price Index, or CPI, and reveals that prices are on a rise. Between December 2016 and December 2017, the CPI increased by 2.1%, which is above the Fed's target rate of 2%. When you look at the less volatile core CPI, which doesn't include food and energy, it increased by 1.8% in the same time period. The CPI-U is the CPI value for urban consumers, which excludes rural populations. So, as we had established earlier, inflation is increasing, but at a relatively reasonable rate. The difference comes when we look at the last 3 months of 2017. During the fourth quarter, the CPI increased by 2.6 at the annualized rate. What does this mean? Inflation increased as the year went on. In 2018, we expect that trend to continue. Prices for housing and services have been increasing, and producer prices indicate that more inflation may be on the horizon. Some analysts believe inflation could hit 2.5%, or even higher by the end of 2018. In December, the Fed Reserve raised interest rates for the third time in 2017. Currently, their target interest rate is between 1.25 and 1.5%. The Fed currently predicts that if monetary policy changes occur gradually, then economic activity will expand at a moderate pace and labor markets conditions will remain strong. The Fed also said they plan to increase rates 3 times in 2018. Ultimately, raising interest rates are a sign the economy is doing well. But what happens when interest rates rise? This chart will help explain. The yellow dotted line represents 5% yield on a 10-year Treasury note. The 10-year Treasury note is currently trading in the mid-2s. Now, look at where the brown diamonds are. They are mostly clustered in the upper left and bottom middle. This arrangement shows that when rates are below 5%, equities tend to grow as the rates increase. But when rates are above 5%, equities tend to decrease in response to rate increases. In other words, history shows us that we may be able to expect the markets to rise as rates increase as long as they stay below 5%. After its December 2017 meeting, the Fed released predictions for GDP and unemployment in 2018 and beyond. As you can see, they predict that GDP will continue its steady, moderate growth, and they expect unemployment will drop even farther in the next few years, hitting 3.9% in 2018. The FOMC is the Federal Open Market Committee. The one area of this chart that we are paying close attention to is a difference in estimated Fed fund rate increases between what the FOMC has projected and what current market expectations are. The FOMC is currently projecting 2 to 3 rate hikes each year over the next 3 years, while the market expectations is only assuming 4 total increases over the next 3 years. So the market is pricing in the assumption the FOMC will slow down the projected Fed fund rate increases to keep the economy growing. If the economy grows faster than expected, and the FOMC keeps their stated course, or worse, starts to accelerate their rate hikes, we could see some serious volatility in equity markets and uncertainty of where rates could go to, as we don't want to see them go above 5%, as we discussed in the prior slide. But the FOMC has a 2.75% as the current long-term projected rate going beyond 2020, which is still a good sign for equity markets if that is the case. As of November 2017, the unemployment rate was 4.1%, which is the lowest level since 2000. With unemployment this low, wages typically rise in response. In this chart, the gray line is unemployment and the blue line is wage growth. Oh, excuse me. The maroon line is unemployment and the yellow line is wage growth. The two measures usually inversely relate. So when unemployment goes down, people can generally expect to earn more for their work. These levels point to a very solid economy. We would expect that wages will begin to grow faster due to low unemployment, which could cause some concerns for corporate profits depending on the pace of that wage growth. This is another area we will be watching in 2017. So, given all these predictions, what were the experts forecasting for domestic equities in 2018? Each year, various media outlets compile the S&P 500 price targets of Wall Street's top analysts. Let's take a look at what they have to say about the S&P 500 this year. Now, these targets aren't ours. They are what the experts are predicting. And as you can see, their 2018 estimates cover a 750-point range, from 2350 to 3100. Proof that even experts often have differing opinions. But while they gave a range of results, one trend is consistent. All but one strategists are predicting that the S&P 500 will continue to rise in 2018. In fact, just days before the year started, a number of strategists increased their estimates for 2018. Citigroup is one of them among the ones listed here. Of the strategists we have included here, their average estimate was 2863, which would be 7.1% growth. These are strong returns, even if they are less than half the 19.4% growth we achieved in 2017. Of course, as we stated earlier in this presentation, we are not trying to foretell the future. No one knows for sure what equities is going to do in 2018. And prediction at this stage is pretty foggy. However, these analysts' perspectives show that, for the most part, optimism continues on Wall Street. We've gone over a lot today. But if you take away just one detail from our presentation, remember this: emotion has no place in investing. Over the past 9 years, we've weathered so many storms, from the Great Recession to global pandemics to terrorism and beyond. And after all these tests and volatility, the market continues to grow and create new opportunities. Let's reference this chart of stock performance since 1980. The average year has a 14% difference between its peak and low prices. But if you look at 2017, you'll see that we experienced hardly any variation at all. When the S&P gained over 19% for the year, it only had a 3% intra-year decline. For 13 months, equities have not experienced a pullback of over 3%, which is the longest streak in history. When volatility is low, it can be easy to forget what fluctuations feel like. But we wanted you to remember the larger intraday declines are normal. An average 14% drop can feel unsettling in the moment, even with these intra-year drops. However, the markets have been positive 29 of the last 38 years. We expect 2018 to bring continued growth in the economy, but volatility will most definitely increase based on our past experiences. So if you ever feel concerned or want to understand what's happening, lean on us for support. We're here for you, and we want to help you and make the most of your financial life. What can you do in 2018 to move towards your family's goals? Here are some action items for you. If something changes in your life or personal situation, keep us in the loop. We want to hear about important family events like births and deaths. We also want to know about health issues, employment changes, and any financial developments, such as an inheritance, that can change your situation. If you find yourself thinking about new goals or reevaluating your priorities, please share your thoughts with us so we can help you pursue the life you most desire. On top of specific adjustments in your financial life, we also want to know if you experience any changes in your feelings about your risk or if you ever have any concerns about the market environment. We're here to talk through whatever financial questions, worries, or excitement you may have, so we can help make the informed choices and keep you on track for your goals. Finally, as we ask you to go over your estate documents, beneficiary designations, and other paperwork to make sure everything's up to date, a well-organized estate is one of the best gifts you can give to your family. Throughout 2018, we're going to focus on delivering the following action steps to you. We want to keep you informed through regular communication, help you manage your investments according to your personalized strategy, and most importantly, stay on top of changes in the market environment and make prudent adjustments where necessary as it pertains to your plan. We've gone through a lot of information here and understand we can't cover all we review and research for our clients in this presentation. We hope you enjoyed a little of the work we do on the investment side of our clients. If you do have any questions, please feel free to reach out to us at 541-330-0220 or at info@myeaglewealth.com. As you can tell, I'm passionate about helping you understand the markets and finding facts amidst the hype. Thank you for allowing me to do what I love. Once again, this is Chad Stasko with Eagle Wealth Management signing off for 2018 State of the Markets.